European Union's Markets in Crypto Assets Regulation, MiCA, represents the world's first comprehensive regulatory framework for crypto assets at continental scale. Regulation of EU 2023-1114 establishes uniform rules for issuers of crypto assets that have so far not been regulated by other EU Financial Services Acts and for providers of services in relation to such crypto assets. This framework covers 27 member states, affecting over 450 million citizens and creating the globe's most detailed crypto regulatory regime outside of individual national approaches. I'm Dr. Eleftheria, and this is By the Rules, a fact-driven podcast that unpacks the regulation, policy debates, and compliance challenges shaping emerging technologies. If you enjoy our work, please like, subscribe, and share the podcast to help others stay informed about emerging technologies, compliance, and regulation. You can also find me on LinkedIn if you have any questions. And now, let us begin. Why does MiCA matter now? The EU's digital finance strategy, launched in September 2020, positioned crypto asset regulation as cornerstone of the bloc's response to financial digitalization and geopolitical competition. The legislation is designed to provide legal clarity and certainty for crypto asset issuers and providers. It aims to boost innovation while preserving financial stability and protecting investors from risks. MiCA's development parallels the EU's broader strategic autonomy agenda as US-China tech rivalry rises. In principle, this could be to the benefit of the European Union, which overall has embraced both a CBDC and crypto assets. A digital euro issued by the European Central Bank could be with us in 2028, pending European parliamentary approval. The regulation addresses three critical challenges. First, the absence of harmonized crypto regulation across 27 member states created regulatory arbitrage and consumer protection gaps. Second, the 2022 crypto market volatility, including the Terra Luna and FTX collapses, demonstrated systemic risks requiring regulatory response. Third, the rise of US dollar-backed stablecoins posed monetary sovereignty concerns for a bloc committed to euro digitization. Now, the timing reflects urgency around technological independence. This has become even more evident in recent months, particularly with the passage of the Genius Act in the United States, which aims to promote crypto assets and US dollar-backed stablecoins worldwide. So, MiCA serves dual purposes, creating an innovation-friendly regulatory environment while preserving European monetary sovereignty through frameworks that support both a digital euro and regulated private crypto assets. Now, broadly, the MiCA regulation defines crypto assets as digital representations of value or rights that can be electronically transferred and stored using distributed ledger technology or similar technology. MiCA employs a technology-neutral, activity-based approach that classifies assets into asset reference tokens. You might know them as ARTs. Are crypto assets designed to maintain stable value by referencing multiple official currencies, commodities, or other assets. Then we have e-money tokens, EMTs, right? Are crypto assets that part to maintain stable value by referencing a single official currency. These include major stablecoins like USDs and Tether. Then we have other crypto assets, including utility tokens, governance tokens, and other digital assets not classified as the RTs or EMTs. Crypto asset service providers, known as CASPs, comprise exchanges, wallet providers, custody services, and advisory firms. Now, by June 30, 2024, MiCA's rules on issuing asset reference tokens and e-money tokens were enforced, and all businesses subject to these rules should now be in full compliance with them. This phased approach reflected regulatory pragmatism, Stablecoins posed immediate systemic risks requiring swift action, while broader crypto services needed more comprehensive preparation time. Significantly, MiCA excludes financial instruments already regulated under Markets in Financial Instrument Directive 2, deposits covered by banking regulation, and digital representations issued by central banks. The regulation covers crypto assets that are not currently regulated by existing financial service legislation. This approach ensures regulatory coherence while avoiding duplication with existing EU financial services law. Let us now think, how did the EU evolve from cautious observer once, right, to comprehensive crypto regulator? The European Commission first addressed crypto assets when, in its 2018 FinTech Action Plan, focusing primarily on anti-money laundering concerns through the 5th Anti-Money Laundering Directive. However, the 2020 Digital Finance Strategy marked as a fundamental shift toward comprehensive regulation rather than prohibition or reactive measures. On 20 April 2023, the European Parliament adopted the regulation, MiCA, and the European Council approved MiCA on 16 May 2023. It was published in the official journal of the European Union on 9 June 2023. The legislation's development reflected iterative consultation with industry members and consumer groups over nearly 3 years. The regulatory philosophy evolved through distinct phases. So basically, initially, the Commission emphasized risk mitigation and consumer protection, drawing parallels with traditional finance instruments regulation. Okay? As the framework developed, innovation element became equally prominent, reflected in the same activity, same risk, same rules principle that ensures proportionate treatment regardless of technology. MiCA's framework's technical standards, developed through extensive European Securities and Markets Authority and European Banking Authority consultation processes, demonstrate the EU's commitment to evidence-based, industry-informed regulation. Now let's think. How did MiCA's phased implementation unfold across European markets? So we have 9 June 2023. The Markets in Crypto Assets Regulation was published and entered into force on the 29th June 2023, starting the work on secondary rules and supervisory infrastructure. Then we have 30th June 2024. Stablecoin rules began. The parts on asset reference tokens and e-money tokens applied. Issuers had to comply or exit the European Union. Stablecoins must hold one-to-one liquid reserves, prompting market adjustments. So some issuers sought authorization, others left. 30 December 2024. Full application of MiCA. So in remaining parts took effect, including public token issuance rules and licensing requirements for crypto asset service providers. Then we have 30 December of 2024, which was basically the same day. The transfer of funds regulation started applying to crypto assets, extending the travel rule. Providers must exchange sender and recipient personal data for transfers to support transparency and prevent money laundering. From January 2025, what do we see? Crypto asset service providers must apply for licenses to operate in European Union. A grandfathering period of up to 18 months allows existing firms to keep operating while they are on the transition. Member states may adopt transitional measures so already active firms can continue during this period. Let us now evaluate the stablecoin regulation focusing on asset reference tokens and the e-money tokens or electronic money tokens. The framework is the most detailed global approach to crypto asset stability. Only issuers that are legal persons established in the European Union and authorized by their national authority under the Markets in Crypto Asset Regulation or credit institutions authorized under the Capital Requirements Directive 4 may offer asset reference tokens to the public or seek admission to trading in the European Union. For electronic money tokens, A full segregated reserve is mandatory. Every token must be backed one-for-one by eligible liquid assets. Reserves must consist of bank deposits, central bank deposits, and high-quality government bonds with at least 30% placed with credit institutions. Together with governance and transparency duties, these rules allow only well-backed stablecoins to operate in the European Union. Issuers of both asset reference tokens and electronic money tokens must hold the relevant authorization to operate. The core requirement in market and crypto assets regulation are complemented by technical standards and guidelines developed by the European Banking Authority, which also supervises significant tokens using thresholds such as number of holders, transaction volume, and market capitalization. Issuers must publish a detailed white paper covering risks, reserve composition, and redemption mechanism, obtain regular independent reserve attestations, and file quarterly reports to supervisory authorities. For crypto assets other than asset reference tokens and electronic money tokens, offerers and applicants for trading admission must act in the best interests of holders and treat them equally. Now, let us focus on the licensing framework for crypto asset service providers. Any company that offers crypto asset services on a professional basis in the European Union must be authorized by the national competent authority in its home country. The law defines 10 services: custody and administration, operating a trading platform, exchange, executing client orders, placing crypto assets, receiving and transmitting orders, investment advice, portfolio management, transfer services, and lending in crypto assets. It covers crypto assets not already regulated by other financial services law, and it sets transparency, disclosure, authorization, and supervision rules for issuers and traders of asset reference tokens and electronic money tokens. Authorized providers must have strong systems and controls, sufficient financial resources, and sound governance. They must protect client assets, deliver best execution, manage conflicts of interest, and meet ongoing capital and liquidity standards. Fit and proper rules apply to members of management bodies of issuers of asset reference tokens and to applicants for authorization as crypto asset service providers, as well as to direct and indirect significant stakeholders. Guidance issued on 4th of December 2024 by the European Securities and Markets Authority and the European Banking Authority assesses skills, expertise, knowledge, and time commitment, both individually and as collective body. Cross-border access uses passporting. One authorized in one European Union country, a provider may offer services across the Union without new licenses, after the required notification to home and host authorities. Now, let us see the market integrity and conduct standards under the Markets in Crypto Asset Regulation. The regulation extends traditional market abuse rules to crypto assets, covering insider dealing, unlawful disclosure of inside information, and market manipulation. Regulatory technical standards set the systems and procedures firms must use to prevent and detect abuse, provide a standard template for reporting suspected abuse, and define how authorities coordinate investigations. Crypto asset service providers must run surveillance across on-chain and off-chain activity to detect wash trading, spoofing, layering, and pump and dump schemes. Providers that give advice or manage portfolios must ensure suitability by assessing each client's knowledge, experience, and financial situation. And the framework uses the client categories from the Second Markets in Financial Instruments Directive retail, professional, and eligible counterparty. Marketing must be fair, clear, and not misleading, with risk warnings about volatility and the possibility of total loss. Finally, the European Securities and Markets Authority has launched a European-wide register under Articles 109 and 110, listing all published white papers, all authorized crypto asset service providers, and non-compliant providers that offered services without authorization. Now let's focus into a hot topic. What's that? Anti-money laundering, counter-terrorist financing, and operational requirements. Crypto asset service providers in the European Union are subject, of course, to the Union's anti-money laundering framework, including the 4th and 5th anti-money laundering directives. The Anti-Money Laundering and Counter-Terrorist Financing Directive 2015-849, as amended, the Transfer of Funds Regulation, Regulation 2023-1113, and the Digital Operational Resilience Act, Regulation 2022-2554. The Transfer of Funds Regulation extends the travel rule to crypto assets. Providers must exchange originator and beneficiary information for crypto asset transfers in line with Financial Action Task Force recommendations, operate systems that detect and report suspicious transactions, and keep transaction records for investigations. The Digital Operational Resilience Act requires strong information and communication technology risk management, incident reporting, and business continuity planning for offerers and applicants for admission to trading who are not otherwise subject to those standards under the Markets in Crypto Asset Regulation or the Digital Operational Resilience Act. Separate guidance cover maintenance or systems and security access controls. Providers must also safeguard client crypto assets by segregating them from the firm's own assets and by maintaining appropriate custody arrangements. Clients' assets must remain protected in insolvency with clear legal paths for recovery. Now, think how enforcement under the Markets in Crypto Asset Regulation has reshaped European crypto markets. By 30 December 2024, the regulation fully applied to authorization of crypto asset service providers and to token issuance rules, with member states running transitional windows into 2025. From 2025, national competent authorities and for significant electronic money tokens and asset reference tokens, the European Banking Authority can use the full enforcement checklist: public notices, orders to cease infringements, suspension or withdrawal of authorizations, administrative fines, and periodic penalty payments. Since enforcement began, penalties exceeding 540 million have been issued to non-compliant firms. The sharpest impacts have been in stablecoins. Official questions and answers clarify that some services, exchange, receiving and transmitting orders, or executing orders, can amount to a public offering of asset reference or electronic money tokens when a provider promotes or advertises those tokens. Since 30th of June 2024, such activity must comply with the regulation. Trading platform operators are therefore expected to stop making non-compliant tokens, those issued by persons not authorized in EU, available for trading. This has driven high-profile delistings. In March 2025, Binance announced the delisting of 9 stablecoins, including Tether's dollar stablecoin for users in the European Economic Area. Spot trading pairs were removed through some derivatives referencing that token remained available due to regulatory nuances. Kraken placed the same token in sell only, made on 24th of March, then fully disabled trading by the 31st of March. Sanctions can be severe. National authorities may impose fines, remedial orders, suspend or withdraw authorizations, publish infringement notices, and issue management bans. Maximum fines can reach many millions of euros or significant percentages of annual turnover may be calculated as multiples of profits gained or losses avoided, and can be as high as 12.5% or 15% of annual turnover, potentially including global turnover. Now, how the markets in crypto assets regulation has reshaped Europe's market structure. Think. The European Securities and Markets Authority has launched an interim European register that lists published white papers, authorized crypto asset service providers, and non-compliant providers until the full information technology system goes live in 2026. The register improves transparency by letting investors and authorities verify authorization status and white paper publications. Compliance pressure is driving consolidation. Many smaller firms lacking the resources to meet the new rules have exceeded or merged, leaving fewer, larger and more compliant firms to dominate. More than 70% of crypto transactions based in European Union now take place on exchanges that comply with the regulation, up from 48% in 2024. Non-compliant exchanges have seen a 40% drop in European Union-based users as traders move to regulated platforms. MiCA compliant stablecoins are filling gaps left by non-compliant alternatives. Examples include Eurocoin, a euro-backed token issued by Cycle, Euro convertible issued by Societe Generale and listed on Bitstamp, and Euro stablecoin issued by Banker Cycle for cross-border payments, each positioned as compliant with the regulation. Industry efforts are also supporting compliance. The MiCA Crypto Alliance, announced on 18th of September 2024 by the DLT Science Foundation with participation from Hedera, Aptos Foundation and Ripple, was created to help the market meet the regulations standards. Now let's think, what regulatory innovations will shape the next phase of the market in crypto asset regulation? The regulation has fully applied since 30th of December 2024, but secondary and tertiary measures are still being finalized. On 13th of February 2025, several delegated regulations were published in the official journal of the European Union. The European Securities and Markets Authority has continued to develop technical standards. In 2024, it delivered the last of more than 30 standards and guidelines mandated by the regulation, and it keeps consultation channels open to refine implementation. Next step priorities include decentralized finance protocols, non-fungible tokens, and stronger cross-border supervisory cooperation. A legislative amendment to cover decentralized finance and non-fungible token is under discussion. The European Central Bank is also considering a digital euro framework anchored in the regulation which would fold stablecoin rules into mainstream finance. There is also an overlap with the European payments regime. In a letter dated on 6th December 2024, the European Commission asked the European Banking Authority and the European Securities and Markets Authority to clarify how the regulation interacts with the second Payment Services Directive. So this was Directive 2015-2366. Now, how the markets in crypto assets regulation positions Europe for digital currency leadership. The Digital Euro project runs in parallel with implementation of the markets in crypto asset regulation, creating complementary rules for public and private digital money. A digital euro will be a central bank form of cash available to everyone in the euro area. Work with national central banks began in November 2023 and is laying the groundwork for a possible launch. The European Central Bank has issued its third progress report on this preparation phase, and the Governing Council aims to decide on issuance by the end of 2025, subject to approval by the European Parliament. The regulation stablecoin framework sets clear precedents for digital payment infrastructure. According to public remarks by the governor of the Bank of Italy, limited uptake of fully compliant stablecoins strengthens the case for a digital euro. Many central bank officials also judge that the regulation alone cannot manage systemic risks from crypto assets without a central bank digital currency alongside it. There are also technology paths that could link the two worlds. Reporting in the Financial Times says that digital euro could run on a public blockchain such as Ethereum, which will help it interoperate with crypto assets regulated under the European framework. Taken together, the European Union's twin-track comprehensive crypto asset regulation plus the potential digital euro positions Europe to set global practice while avoiding sudden risks to the banking system. Now, what strategic imperatives emerge from MiCA's implementation and market evolution? So, based on comprehensive analysis of the MiCA's regulatory framework and the market impact, the strategic priorities that emerge. So when we look at it from national competent authorities' perspective, we have to speed up licensing, now 3 to 6 months, without lowering due diligence. Strengthen cross-border enforcement via the European Securities and Markets Authorities convergence work, especially on non-compliant stablecoins. By 30th of June 2025, member states notified the European Securities and Markets Authority and the European Banking Authority of responsible bodies and national measures. Then build specialist teams that combine financial supervision with blockchain analytics and technical assessment. For crypto asset service providers now, aim for full compliance. Almost compliant is high risk under the current enforcement. Adopt governance that meets fit and proper standards from the joint guidance effective December 2024. Invest in anti-money laundering. This is very important. Invest in anti-money laundering and counter-terrorist financing systems for the travel rule and cross-chain monitoring. Strengthen operational resilience under the Digital Operational Resilience Act, including incident response and business continuity. Now, for stablecoin issuers, secure European authorization before launch. Recent delistings show zero tolerance for unauthorized activity. Maintain full segregated reserves with clear liquidity buffers. Put governance and risk management in place to support direct supervision by the European Banking Authority for significant tokens. Provide transparent reporting with quarterly reserve attestation and continuous compliance monitoring. Now, for market infrastructure, what you should do? Upgrade surveillance to detect abuse across on-chain and off-chain flows. Was trading, spoofing, layering, manipulation. Enhance custody and settlement so client assets are segregated and protected in insolvency. Develop interoperability standards that support both markets in crypto assets, compliant crypto assets, and a possible digital euro link. Now, for industry associations, expand collaborative compliance programs, the MiCA Crypto Alliance model, to standardize practice and reduce costs. Advocate clear rules on decentralized finance protocols and non-fungible tokens and feed industry input into upcoming amendments. Create sector standards for sustainability reporting and environmental impact disclosures required by the regulation. And now for the investors and market participants. Verify authorization in the European Securities and Markets Authority register before using any provider. Diversify stablecoin holding across several compliant issuers to reduce concentration risk. Track rule changes affecting decentralized finance protocols and cross-border services. What the markets in crypto assets regulation means for global crypto asset regulation. The markets in crypto assets regulation positions the European Union as a global pace setter. It offers a clear middle path between ban-heavy and hands-off regimes by combining innovation with strong consumer protection. Its technical standards, spanning reserve composition, disclosures, and market surveillance systems, give other jurisdictions a practical template that can adapt. The regulations technology neutral activity-based approach is designed to endure as new tools and business models emerge. However, key challenges remain. The interaction with payment services law needs clarification. Rules for decentralized finance and non-fungible tokens are still being developed. Cross-border enforcement will also require stronger international coordination. And above all, success depends on consistent information across the 27 member states during transitional periods that run into 2026. If national approaches diverge, regulatory arbitrage risks will persist. Now, looking ahead, the digital asset regulatory landscape into 25-26, the markets in crypto asset regulation is a starting point, not the finish line. It builds the regulatory infrastructure for both private crypto asset innovation and a possible digital euro, a dual track that positions Europe for leadership regardless of which technology wins out. Its influence reaches beyond Europe by setting technical standards and clear compliance benchmarks for global crypto asset service providers. The framework offers other jurisdictions a ready template they can adapt as they build their own regimes. For practitioners, this marks the mainstreaming of crypto assets into traditional oversight. The framework plugs into existing European Union financial services law from the Second Markets in Financial Instruments Directive, conduct standards to anti-money laundering and counter-terrorist financing requirements, showing the move from niche technology to a regulated financial services sector. Europe has the world's most comprehensive regime for crypto assets, balancing innovation with strong consumer protection and financial stability goals. Implementation under the markets in crypto asset regulation supports sustainable market growth while preserving monetary sovereignty through complementary digital euro work. Success from here depends on three things: continued development of technical standards, consistent cross-border enforcement, and adaptive supervision that support innovation within clear risk management limits. And we reach the end. If you found this episode useful, please like, follow, and share. Thank you. Till next time.